companies have hedges that are actually commercial and not bets. Okay? They deliver into them. Well, once those contracts expire and they're done with them, they go to a new round, and maybe they have others that they hedge where they were selling at 55 for a while. Right. But now they're going to have to deal with the reality of the market. Okay, the oil, the energy sector, it's not just that, it's gas too. The energy sector is a very big risk, and it's a present-day risk. But there are other big risks to the banks right now, and I believe the interest rate derivatives and other derivatives, they're whacking the banks in ways that we just don't see. Their derivatives are bouncing around. Just think of waves hitting a dock. Okay, you've got some nice artwork or some pottery on the dock, and it's getting knocked over by some waves. That's kind of the damage that you're seeing from the derivatives. Just movement up and down, like with waves, is hitting the bank sector because they can't quite manage things like they used to. In December, this is a key point regarding the leverage and the risk from the waves damage. You know, just the simple oscillation in the markets. In December, there was supposedly an interest rate hike, and maybe there was. I thought for a while that there was not, because the effective Fed funds rate was only up 8 or 12 basis points when we were told there was a 25 basis hike. But now it looks like they did a rate hike. But what happened was they accelerated the reverse repo, which means the Fed took cash from the Wall Street banks and the major banks and gave them treasuries with a specific purpose to use the treasuries as instruments to leverage up, way up. So the interest rate hike from December of last year was not so much to bring about normalcy in the monetary policy regarding interest rates. The rate hike was to force the banks to increase their leverage, force the banks to shed their cash, bring in more treasuries, lever up, and balance out the effect of all the artificial interest rate swap derivative demand for treasuries. There's almost no demand internationally for treasury bonds anymore, yet there's ample demand within the market. It's coming from the derivatives. You're having China divest $250 billion in July, August, and September last year of treasury bonds, but the interest rate did not go up. Why is that? Because the interest rate swap machinery is producing artificial demand. Okay, the point I'm bringing back to the banks here, I mean, I got off to the tangent there, but for a reason. The big banks are now super leveraged with respect to the treasury bonds. So any oscillations, any volatility that you see in either the stock market or the bond market severely whacks the big banks because derivatives cannot handle movement. And the analogy I like to give is, imagine the Sears Tower. You can't talk about World Trade anymore because they demolished that. The Wall Street bankers demolished that, along with military and security agency assistant. They demolished the World Trade Center. If I were at the 120-story Sears building in Chicago, and suddenly it's 180 stories, and it's a little narrower. Why is it narrower? Because the big banks are even more leveraged with a smaller base of treasuries. Like the Sears Tower would be even more leveraged for its height by a narrower base and footprint. So if you have 180 stories as opposed to 120, and the Sears Tower is now with a smaller base, is it not more vulnerable to the winds? Okay, the answer is obviously yes, and that's what's going on with the banking system. I believe that the banking system in 2008 and 9 went completely insolvent And now I believe that primarily due to the energy sector losses and with increased losses through volatility, etc., with the derivatives, the big banks are facing illiquidity problems. At the same time, the Fed is coming in and saying, we're not going to be your last resort for bailing you out anymore. And it got confirmed in some recent FDIC reports directed at Goldman Sachs and JP Morgan. Since when does a U.S. government quasi-agency like FDIC issue a report to JP Morgan telling them that they're over-leveraged and cannot handle another financial crisis?
Right.
No. We're in a new chapter here. And I think the Chinese have told the U.S., get rid of your too big policy.
Yeah.
Get rid of it. Let them squirm in the wind.
Yeah.
So the Fed is saying, okay, they can squirm in the wind, but we're going to increase the leverage. In other words, we're going to reduce the base of the Sears Tower as it gets taller.
Right.
Okay, this is all very dangerous stuff. And I think we're going to see a bank failure. And I think it's going to be an extension of Deutsche Bank action in Europe or JP Morgan action in the United States. I don't think any trigger is going to come from Canada. They're too much a tail on the U.S. dog.
It